Hi, in this video, we're going to do a detailed financial analysis on Asian Paints. Look at its numbers, how are they moving, what's causing the movement. Detailed analysis करेंगे Asian Paints के numbers पे. थोड़ा सा लंबा video होगा, slightly longer video, but stay with me till the end and you'll have a good understanding on the sector and what's moving its numbers. If you haven't subscribed to our channel as yet, please do so. You will definitely find some value in a lot of the other videos that are there. Some other videos which might be relevant from the perspective of where to get data, what to look in annual reports. All of those links would be available in the description as well. So let's dive right into this financial analysis of Asian Paints. Numbers, we will be downloading them first. Let's say we've put all the numbers on an Excel file and those numbers are available on the screen as you see. Where do you get these numbers from? Primarily, ideally, I would want and suggest that initially when you're starting financial analysis, जब आप financial analysis शुरू कर रहे हैं, तो numbers को annual report से लें. All websites make some minor changes in the numbers and we do not want that to kind of impact your analysis. If you have to do any changes, you do them yourself. Over a period of time, जैसे जैसे आपका prowess बढ़ता जाएगा, जैसे जैसे understanding बढ़ती जाएगी, as you kind of gain more understanding on the numbers and sectors and ratios, then you move towards, let's say you can download numbers and then work with that, right? Also, another big advantage of putting in numbers from the annual report is when you're punching in numbers, if there's a bigger number, you get a sense of, acha, ye number bada hai, ye number chota hai, this is something that would impact my analysis or not, right? So that becomes a key element. So we have taken the last 4-5 years of numbers of Asian Paints, balance sheet, P&L, all of those are here. Now we will jump right into ratio calculation. So the first step is we'll try and do a ratio calculation. Step 2 is when we will try and understand what is happening to those trends in those ratios. And step 3 is then we try and decode ki, acha, what is really causing that trend to happen, right? So this is the P&L. We'll start right with an understanding of calculation of a few things. We'll see multiple sets of revenue details are given. I'll just insert a row here. So what we'll do is we will say operating revenue, right? So overall, what is the operating revenue? And that's basically the sum of the top 3 line items that we see. This is the operating revenue. And then we have other income that kind of comes, which gives me the total income. So our calculations mostly would be on operational revenue. So we are going to focus on this row a lot as we go along. Additionally, we have to basically calculate things like what is the EBITDA. Now here, as the annual report gives it, the EBITDA is calculated in the context of including other income as well. You will note this number would basically be 36,183 minus 27,910. So we will calculate operating profits separately. And what I will do is I will basically take operational revenue and subtract the total expenses from this, right? So that number may be slightly different than what is the EBITDA number mentioned above. Let's see what is the issue happening here. Have I linked it incorrectly? C8 to, acha, I have missed the cells. It should be B8 minus B17, minor error. So that solves for it. We get what is going to be the operating profit without other income, correct? यहाँ इसे operational revenue कर देते हैं. Let's put this as operational revenue, correct? Or revenue from operations is what we are looking at. And then there's other income which is going to be excluded in that context. From this, if I arrive at EBIT, here I can include the other income because technically in EBIT, I can use the other income to repay the finance cost. So I can take EBITDA and from there subtract the depreciation. And this is my EBIT as I would calculate it, right? Let's dive right into the ratios. So we'll start with profitability ratios. The first one would be operating profit margin, which would be operating profit by revenue from operations or operational revenue, right? So that's what we are basically looking at. Operational revenue is what we will look at. We can look at EBIT margin. We can look at net profit margin, right? So this will be EBIT divided by revenue, and I can use revenue from operations, but because in EBIT we are including other income, so we'll use total revenue. And net profit margin is also net profit by total revenue, right? I mean, you can choose to use your definitions. There's no hard and fast rule that this definition is the only one that has to be used. Just use it consistently across whatever the numbers you're using, right? Let me also write down the other ratios. So let's say we'll do return ratios. So we'll say return on equity. We'll say return on capital employed, ROE, ROCE. This will be net profit divided by equity. Equity will include share capital reserve surplus. This will be EBIT divided by equity plus debt or borrowings that are there. Correct. So we'll calculate all the major return ratios that are there. Again, within this, you can choose to kind of include your lease liabilities if you want to, or leave them out consistently. That's okay. Should not be such a big hassle. We will calculate debt ratios. So we'll calculate debt upon equity and interest coverage ratio. Debt upon equity is total borrowings divided by equity. Interest coverage is EBIT divided by finance costs. So we get these two ratios. We will look at turnover ratios, right? Turnover ratios. So we'll, let's say, look at total asset turnover. We will look at receivables turnover. We will look at inventory turnover, and we will look at, let's say, payable turnover. In all of these ratios, typically, while textbooks may suggest otherwise, I recommend using sales in the numerator. So this will be sales upon total assets. And then we will look at sales upon receivables. We will look at sales by inventory. Basically, whatever is the turnover ratio, sales upon that metric is what we are looking at. Payables, right? And then we will sort of look at working capital in terms of days sales outstanding. So we will look at receivable days, we will look at inventory days, and payable days. That will give us the cash conversion cycle. We can also do Dupont analysis, right? So Dupont will have its own set of calculations, and some of those numbers we would have calculated. So we'll just try and multiply and see if we get the return on equity using that, right? So this will come through Dupont. We'll look at some more ratios as we kind of go along. So let's try and start with this. This would be 365 divided by the turnover ratio, right? Basically receivable turnover ratio. So let me write a short form, RTR. 365 divided by inventory turnover ratio and 365 divided by payable turnover ratio. So that's what we are going to calculate. Let's jump right into it. Operating profit by revenue from operations. So operating profit divided by revenue from operations or operational revenue, we get that. EBIT margin would be EBIT, which we have calculated here. EBIT divided by total revenue or total income. Once again, I'll reiterate, it is not necessary that you use total income. You can use operational revenue. That's absolutely fine. Just remove other income from all your calculations and that should work, right? And net profit generally includes other income because it's post-tax. So net profit ideally should be profit after tax, that is divided by total income. So this is your net profit margin. All these three are percentages. So we'll put percentages and we can then, drag it on the right side. We'll do that. Return on equity is net profit. Let's look at the equity on the balance sheet. So on the balance sheet, when I go and I check out, I have been given a total equity number, equity attributable to owners of the company. Remember, in the net profit, we have not removed minority interest as yet, right? Let's check if we have removed that. We haven't. So because we have not removed minority interest, I'm going to take this as the total equity number. And this is what we are going to use in our ratios, right? So very quickly, this is P&L, profit after tax, divided by balance sheet total equity. Achha, here you can use averages as well. So that's absolutely fine. I'm just keeping it simple, but you can use average equity. You can use average equity plus debt. So when balance sheet numbers are being used in ratios against a P&L number, a common practice is to use averages of the balance sheet number because that gives you a beginning of the year and end of the year number and then an average around it. But if you're doing this analysis consistently across many years, then it evens itself out. If you're doing it for one specific year, then maybe taking an average makes more sense, right? Let's look at this number. So this is EBIT, which is calculated here. So let's look at EBIT divided by, now I have to add all the equity and debt. So total equity plus borrowings here plus borrowings here. If you want, you can add lease liabilities, just keep it consistent what you do. In this particular business, not a whole lot of lease liabilities, so it's not going to impact your analysis too much in that context. So that's my ratios here. Debt upon equity is, I will go to the balance sheet, look at all the borrowings that are there, right? And divided by the equity, which is a fairly low number in terms of debt to equity. EBIT upon finance cost. So let's look at EBIT divided by the finance cost. Now, remember, this finance cost is coming on account of a lot of your lease liabilities. That's an accounting treatment because post 2020, your operating leases have been kind of incorporated and put up as financial leases. So if you have rented something, let's say I rent a factory or a building, I have to assume that I have borrowed money and bought that asset. तो ये दोनों साइड पे ऑन द बैलेंस शीट आपके एक साइड पे लीज लाइबिलिटी आएगा, दूसरे साइड पे राइट ऑफ यूज एसेट आ जाएगा. करेक्ट? That aside, that's okay. Now I look at sales. So I'm going to look at operating revenue only on the P&L, and I'm going to divide operating revenue by total assets. Again, you're free to use total revenue. That's fine. So that's okay. I'm just keeping it consistent by using operating revenue. So 1.25 sales upon receivables will be operating revenue divided by my receivables. On the balance sheet asset side, where are my receivables? Trade receivables are here, current assets. Then I look at inventory turnover. So operating revenue once again and divided by the inventory. So where's my inventory? Here. And payable turnover, operating revenue, and divided by the payables on the right side. So here I have to add two of them. Right, so let's do this, MSMEs plus this, and then let's put a bracket on this. So it gives me the answer here. So these are my turnover ratios that we have calculated. Let's format them as well. And in terms of days sales, 365, so equal to 365 divided by receivable turnover, payable, and so I get these data points. I can again sort of keep it consistent. And remember, Dupont is nothing but NPM into asset turnover ratio into leverage factor, which is basically assets upon equity. So if I basically were to take the net profit margin, let's see if this works, into total asset turnover into, I need to now put a bracket and say total assets on the balance sheet, which is here, divided by equity. So this should basically give me a number. Let's put a percentage to this, and ideally this should match what is my percentage under return on equity. So that gives me my components of return on equity and how they have been moving and what's the details. Let's embolden all of these. इनको bold कर देते हैं ताकि हमें idea रहे what's really happening here. I can calculate cost ratios as well. वो हम P&L वाले sheet पे ही कर लेंगे. We'll try and basically do a vertical analysis very quickly to understand what are all the costs as a percentage of your major sales items, right? So this is what we have done. We have all the details which are available. We can look at trends, what's happening in these numbers. Why is that happening in these numbers? Let's try and decode that as we go along. Before we go there, let's quickly look at a couple of other things. On the P&L, what I'm going to do is just a simple vertical analysis. You can put up numbers like, okay, what is cost of materials purchased as a percentage of my sales, and I want to freeze the operational revenue row but not the column. So I will freeze the row $8 and I will put a percentage to this. I will pull this down. So I have all the major expenses that are there. Where are they coming from and what's happening across the years, right? And you can basically point out specific numbers. For example, FY22, you saw a massive jump in cost of materials consumed. right? You also saw purchase of stock in trade is the highest number there. So raw material cost basically spiked up a lot. Ideally, if that has not resulted in sales going up, you should see a margin going down at that point of time, right? So if you look at these numbers and you say, okay, this is what has happened in specific years, let's look at what's happened to margins in those particular years. If you look at ratios and you calculate the margins, you'll see, okay, there is a definite dip in operating margin in that particular year. So that kind of relates to the idea of where is the margin decline coming from? Why is the margin decline happening there? Then it's again gone up in the last year, and it might make sense for us to go and check what's happened in the 9-month data in this financial year so far to get a sense of what's the real story that's happening here. You will also see something interesting in terms of some of the other data parameters, which is receivable days seem to be going up, right? So this is going up. I can note down key elements. This is stable. This is payable is stable. I can look at my asset turnover is basically stable. Nothing major changes there. Coverage ratio is stable. Good. There's no problem. Enough. This thing, very low debt. So this doesn't look like a very capital intensive business, right? I mean, if you go to the balance sheet and you look at overall asset size, that's at this point of time about 29,924 crore. But if you look at fixed assets, basically, right, that's the sum of some of these elements which are there. I mean, if I look at just pure fixed asset data, that's about 10,000 crore. So 10,000 crore ke sales pay, ke asset base pay, the company is able to generate sales of about 35,000 crore fixed asset. So if I calculate fixed asset turnover ratio, that is something like 3.5. So it's not a very capital intensive business. And my overall balance sheet size, essentially, with a 10,000 crore investment, I can double my capacity. On my P&L, I'm basically getting about, 5,000 odd crore of profit. So whatever my capacity is today, with 2 years of profit, I can practically double that entire capacity. Not a very capital intensive business, was a decent margin business. So if it's a decent margin business, not very capital intensive, good return ratios, a lot of decent returns being generated on the company's numbers, then you would assume that in some form or fashion, competition will come in the sector. And that's exactly what has happened. So you see declining margins, now 21%. What we should also look at is what really happened when Grasim announced its entry into the financial markets. So what happened is somewhere 2021 beginning, Grasim came and announced its entry into the paint sector and said that we are going to kind of come up and become a major paint player. Asian Paints had a capacity of, if I'm not wrong, 1.7 billion liters. Grasim announced that they are going to basically put up a capacity of 1.3 billion liters. And we know that it's not very capital intensive. Basically, if you have 10,000 odd crore, अगर आपके पास 10,000 crore रुपए हैं, तो आप reasonable amount of capacity लगा सकते हैं. General scenario, if a large player challenges the market leader, surely not good news. Increase in competitive intensity, pricing power of existing players should go down. So we noted this in 2022, and we will note that pricing power impact, obviously the capacity has come on stream now in the recent few quarters, and that should ideally be evident in the financial numbers. So if we go to Asian Paints and its financial numbers in the quarters, you will note that the operating margins, which used to be in the range of 90% earlier, in one of the quarters fell to 15. December quarter was also 19. So slightly on the lower side as compared to what it was in the last year, right? And goes back to 2022 period where they were not able to pass on the hike in the material cost that was happening. That kind of started coming back and impacting them. So margins have come off a little bit. I think growth has come off a little bit. This is because of probably competitive intensity coming into the sector. Logically, in this kind of a scenario, what is likely to happen is your stock price is going to stagnate somewhere 2021. Now, that doesn't mean they will really end up suffering. It's just that when a big player is entering, there's going to be pricing pressure. And so you note that the stock price has sort of been stagnant for nearly now 4 years or so in this context. The PE ratio is more interesting. So there was a period where if you look at the last 10-year PE ratio for Asian Paints was trending upwards till close to about 2021 mid. And then there was a derating that has happened. Mind you, during this period, profitability has grown. ऐसा नहीं है कि profits नीचे गए. अगर आप वापस से numbers को check करेंगे, so you will note that during this period of 22 and 23, profits have gone up from 3,000 to 5,500 crore. This year is a little bit lower because obviously now the competitive pressure is coming into the markets and that's what is happening. But the idea is when you look at these ratios, जब आप ये numbers को देख रहे हैं, this should evoke a question in your mind ki why is the margin going up or why is the margin going down, and then you go and search around this on various sources if there's any news that is available and try and correlate with that, right? Why does this not happen in other sectors? Is because other sectors may have capital intensity points and you may want to kind of check what works out here. Here there is very little sort of entry barrier in the sense of putting up capacity. Of course, there's an entry barrier in terms of distribution. So generally what happens is in these kind of scenarios, the top players don't suffer as much in the longer run. The smaller players start suffering a lot more, right? Purely because Asian Paints will have the distribution network to take on this kind of competition that is coming in. In the short run, you can't comment because obviously there are discounts that are running. There's a slight slowdown in the economy that is happening, coupled with a new player coming in, trying to kind of gain market share. There are going to be these pressures that are going to come out, right? You will also note the same impact appears in their receivable days as well. Receivable days are going up and there's no real reason for it to go up other than the fact if we believe that, they are being proactive to kind of work with their dealers and distributors and say, okay, it's fine. You pay after a little bit of while. So either in the form of discounts or in the form of relaxed credit terms, that is what is playing out, right? Dupont seems to be doing okay. So I don't think ratio and return on equity, etc. seems to be doing fine. Doesn't look like that is a very big issue as such in terms of what's really playing out with the numbers here, right? So that's the construct of what we have with respect to Asian Paints. Obviously, there are more nuances, more details that you can look at when you're going to look at this as a segment. So I would urge, please go to the annual report, look at data, look at their conference call transcripts, look at that data. We have videos on what should you read in an annual report, what should you look for in a conference call transcript. Look at those data points, you'll get enormous information about the sector. In order, if you can do this, that kind of adds a lot of value to your understanding of the sector. That's broadly it in this particular video. Try it out, do it at your end, and you'll find that, you'll have a decent understanding of the sector. Pick up any company and do this. If you like the video, please subscribe to our channel if you haven't done so. If you have any thoughts, comments, please share that in the comment section. Happy to hear your feedback. Thank you.